What if I told you that the biggest financial bubble in history isn't where you think it is? While everyone's preparing for another housing crash or stock market meltdown like 2008, the real danger is hiding in plain sight. And when this bubble finally bursts, it won't just wipe out your savings. It'll fundamentally change how money works forever. I'm talking about a once-in-a-lifetime financial reset that's already begun, and most people have no idea what's coming. The warning signs are flashing everywhere, but everyone's looking in the wrong direction. Today, I'm going to show you exactly where the real bubble is, why this crash will be completely different from anything we've seen before, and most importantly, how you can not just survive it, but actually multiply your wealth while everyone else gets blindsided. Let me start with something that should terrify you. For the first time in over 30 years, we're seeing a massive divergence that tells us the entire financial system is beginning to crack. Consumer confidence in the stock market is sitting at one of the highest levels in 3 decades, even higher than the euphoric readings from the year 2000. But here's the shocking part. At the exact same time, people's confidence in their own economic future has plummeted to levels we haven't seen since the depths of the great financial crisis. Think about what this means. People believe the stock market will keep going up forever, but they've never felt worse about their own financial prospects. This has never happened before in modern history. It's like watching a car speeding toward a cliff while the driver thinks they're on a smooth highway. This divergence is not just a statistical quirk. It's a symptom of a problem with extremely deep roots. And as we're going to see, it requires a complete economic reset before it can be resolved. But first, let me show you why everyone's preparing for the wrong kind of crash. Most people are stuck fighting the last war. They're expecting another 2008-style deflationary crash, where housing collapses, banks fail, and stocks drop 50% or more. That's what happened in 2008, and it's what the media keeps warning about. Look at the debt levels, they say. Look at the inverted yield curve. Look at all the traditional warning signs. But here's what they're missing. Those were deflationary crashes. When assets crashed, the money was still good. If you had cash on the sidelines, you could swoop in and buy homes and stocks at fire sale prices, then ride the recovery back up. That's why so many people are sitting in cash right now, waiting for their chance. The problem is, that's not the kind of crash that's coming. This time we're facing something completely different. What I call a reverse market crash. Instead of deflation destroying asset values, we're seeing inflation destroy the value of money itself. When money becomes the bubble, there's no reset button. There's no chance to get back in later at lower prices. Let me show you the evidence. Since late 2023, we've seen some of the most dramatic asset price movements in history. Bitcoin has surged over 180%. Gold, which many wrote off as dead money, has climbed nearly 95%. Even traditional stock indexes like the Nasdaq and S&P 500 have moved up 50% or more. But notice what's lagging. Broader market indexes and anything denominated in cash. If you've been sitting in cash waiting for a traditional crash or following conventional diversified strategies, you'd be massively behind right now. A simple equal weight allocation in the top performing assets would have nearly doubled the portfolio in just 2 years, while traditional strategies barely kept pace with inflation. This isn't speculation. It's already happening. And if you've been feeling like you can't afford the same lifestyle you had a few years ago, congratulations. You're already living through the early stages of this reverse market crash. So where exactly is the real bubble? It's hiding in the one place everyone thinks is safe: government bonds and the dollar itself. Think about it. US treasuries are supposed to be the safest asset in the world. The dollar is the foundation of global trade. But today, both are being inflated away by trillions of dollars in new debt and endless money printing. The US government is borrowing over $2 trillion a year just to stay afloat. And the only buyers left are the Federal Reserve and passive flows forced into treasuries by regulation. When the foundation of the entire financial system is the bubble, everything built on top becomes unstable. This explains all the seemingly irrational market behavior we're seeing. Why are tech stocks hitting record highs? Because they feel safer than holding dollars. Why are people spending serious money on digital collectibles and crypto assets? Because when the underlying currency feels unsafe, you're willing to leap into anything that offers scarcity and value outside the traditional system. What looks like speculation or bubbles in individual assets is actually rational behavior when you understand the context. These are safe haven bids, not reckless gambling. Capital is fleeing from currency and bonds into anything that can't be printed away. The massive inflows into Bitcoin, gold, and even real estate make perfect sense when you realize that smart money is quietly moving away from cash because they see through the illusion that traditional safe assets are actually safe. The so-called bubbles in tech stocks and crypto aren't bubbles at all. They're life rafts. But here's why this reverse crash is going to be worse than 2008. In 2008, when the housing and credit bubbles collapsed, it was devastating, but it was also a reset. Homes got cheaper, stocks went on sale, and eventually new buyers could step in. The next generation had a chance to get back in the market. But today, with the bubble being in money itself, there's no reset button. There's no better chance to get in later. Instead of asset prices falling to meet you, they're going to keep running away from devaluing currency. Housing doesn't get cheaper, it gets permanently out of reach. Your savings don't become more valuable. They get inflated into nothing. Retirees on fixed incomes get crushed. Young families get locked out of asset ownership. The middle class gets hollowed out. That's why this crash is worse than 2008. In 2008, at least you got another chance if you survived. This time, there's no second chance unless you already own the right assets before the system breaks down completely. Let me show you the deeper structural problem driving all of this. Real personal income growth in the United States followed a steady trend of about 2.8% per year from the 1960s until 2008. This long-term trend gave people a sense of what to expect from their future earnings and the ability to make financial decisions based on those expectations. Since 2008, personal income growth has fallen short of this long-term trajectory. Someone in 1999 could have had certain expectations about what their income would look like 20 years later. The reality is that for the last decade and a half, those financial expectations have never been met. What makes this worse is that the gap has recently begun to widen again since the pandemic. On the flip side, the stock market has exceeded everyone's expectations. Since 2010, real personal income has risen by only about 50%, while the S&P 500 has soared nearly 300% even after adjusting for inflation. This gap between the financial economy and the real economy can't go on forever. And here's the mechanism that's driving this divergence. Since the 1980s, the average personal savings rate in America has been trending lower, falling from around 13% to just 4% today. At the same time, corporate profit margins have been steadily climbing. This isn't a coincidence. Corporate profits ultimately get distributed to shareholders. Unlike wage earners, shareholders don't spend most of the income they receive. Instead, much of it gets reinvested back into financial assets like stocks, real estate, gold, and increasingly Bitcoin. We can see the results all around us. Record home prices, gold hitting new all-time highs, Bitcoin adoption accelerating. The real problem begins when this dynamic filters through to housing. Throughout most of the last 60 years, the average price of a home was roughly 4 times the yearly household income. Since the late 1990s, that ratio has moved to roughly 7 times income, making housing about twice as unaffordable. Since shelter is the largest component of the Consumer Price Index, this has a disproportionately large impact on people's budgets. If a larger share of someone's income goes to housing, that naturally leaves less room for saving and virtually nothing left to invest in the very assets that have been compounding wealth for those who can afford them. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. In practical terms, this means many households remain stuck exactly where they are throughout their lives. Their expenses rise with inflation, but their ability to build wealth through asset ownership doesn't keep pace. We can see the psychological impact of this shift. Back in 2000, roughly 75% of Americans said they had a good chance of improving their standard of living. By 2010, that had dropped to 50%. Today, that number has fallen to just 25%. This is all translated into the highest level of wealth inequality in America since the 1920s. And here's where history gives us a clue about what comes next. The last time wealth inequality reached these extreme levels was right before the Great Depression. The peak in wealth inequality in 1929 coincided perfectly with the top of the stock market. But something interesting happened after that crash. The market collapse between 1929 and 1940 coincided with the beginning of a reversal in wealth inequality. This shift didn't happen on its own. It required a catalyst, a trigger that forced what many would call an economic reset. That trigger was a massive increase in corporate tax rates. In the 1910s, the top marginal tax rate on corporations was essentially zero. Policymakers then pushed it to nearly 40% over the next few decades. This was economically painful. It squeezed corporate profits, dragged asset prices lower, and caused unemployment to rise. But it did help reverse the wealth inequality trend. These high corporate tax rates coincided with an extensive period of low wealth inequality in America, roughly from the 1940s through the 1970s. In the 1980s, however, corporate tax rates came down dramatically. The economy accelerated through the late 1980s and 1990s with strong growth and large appreciations in asset prices. But behind the scenes, these policies set the stage for wealth inequality to begin climbing again. Today, as corporate tax rates have fallen to the lowest levels since the 1930s, wealth inequality has risen to the highest level since the 1930s. This isn't a coincidence. Lower corporate taxes have allowed profit margins to stay resilient even while consumers have been under pressure. This pattern suggests that the Great Reset many people are looking for will likely come when corporate tax rates finally reverse and start moving higher. This will probably cause significant pain and cause asset prices to drop violently, similar to what happened in the 1930s. But here's the crucial insight. The stock market typically discounts future events. It's possible that markets could peak before corporate taxes actually begin to rise, just like what happened in 1929 when the market peaked a year or two before tax rates were increased starting in 1931. Now, you might be wondering, if this reset is coming, shouldn't we just sell everything and wait? That's exactly the wrong approach. Remember, we're not facing a deflationary crash where cash becomes king. We're facing an inflationary environment where cash becomes trash. The winners in this environment are the people who front to run the collapse by owning scarce assets that can't be printed away. Assets like Bitcoin, digital scarcity that governments can't manipulate, gold, the oldest form of hard money, prime real estate in desirable locations, businesses with real cash flow that can rise with inflation, even collectibles and other stores of value outside the traditional monetary system. Meanwhile, the losers are the ones sitting in cash, hiding in government bonds, or thinking they're playing it safe with diversified portfolios that won't keep up with the real rate of monetary debasement. This is why the recent performance of different asset classes tells such a clear story. Bitcoin's 180% gain isn't a speculative bubble. It's a flight to safety from currency debasement. Gold's 95% surge isn't irrational exuberance. It's a return to sound money principles. Even the strong performance of certain stocks reflects money seeking refuge from currency instability. The massive inflows into these assets aren't driven by greed or speculation. They're driven by fear. Fear that the foundation of the financial system is cracking. And that fear is completely rational. But here's what most people don't understand. This process is still in its early stages. We're seeing the initial phases of capital flight from currency and government bonds into real assets. As more people wake up to what's happening, this trend will accelerate dramatically. The challenge is that once this process reaches a tipping point, it becomes a self-reinforcing cycle. As more people lose confidence in the currency, they move into real assets, which drives prices higher, which attracts more capital, which further undermines confidence in the currency. Eventually, this becomes a full-blown currency crisis. This is why timing matters so much. The people who position themselves correctly before the crowd catches on will see massive wealth creation. Those who wait until it becomes obvious will find that asset prices have already moved far beyond their reach. Think about it this way. We are potentially witnessing the early stages of a fundamental shift in how the global monetary system works. For over 50 years, the world has operated under a system of fiat currencies backed by nothing but government promises. The system has allowed for unprecedented levels of debt accumulation and money printing. But every fiat currency system in history has eventually collapsed under the weight of excessive money creation. The signs we're seeing today, the divergence between asset prices and real economic conditions, the flight to alternative stores of value, the breakdown of traditional financial relationships, are classic symptoms of a monetary system under extreme stress. The question isn't whether this system will eventually break down. The question is how quickly it happens and whether you'll be positioned correctly when it does. Now, I want to be clear about something important. I'm not predicting the end of the world or the collapse of civilization. What I'm describing is a financial reset, a fundamental restructuring of how money and value work in the economy. These resets have happened many times throughout history, and they're often followed by periods of tremendous prosperity for those who understand what's happening. The key is recognizing that we're in the middle of this transition right now. The old rules about safe investments and portfolio diversification were designed for a different monetary environment. They may not work in an environment where the currency itself is the bubble. This is why it's crucial to think differently about risk. The conventional wisdom says that government bonds are safe and Bitcoin is risky. But what if that's backwards? What if holding government IUS denominated in a rapidly debasing currency is the real risk while owning scarce digital assets is actually the safer choice? The evidence is already clear for those willing to look. Over the past several years, the supposedly risky assets have dramatically outperformed the supposedly safe ones. This isn't an accident or a temporary anomaly. It's a reflection of a fundamental shift in the nature of money and value. But here's the opportunity that most people are missing. Because this shift is happening gradually rather than all at once, there's still time to position yourself correctly. The smart money has already figured this out, which is why we're seeing massive institutional adoption of Bitcoin, record gold purchases by central banks, and continued strength in real assets despite economic uncertainty. The question is whether individual investors will recognize this trend before it becomes blindingly obvious to everyone. By the time the mainstream financial media starts recommending Bitcoin and gold over treasury bonds, the biggest gains will have already been made. This is your chance to get ahead of one of the biggest financial shifts in human history. Not by gambling on speculative trades or chasing quick profits, but by understanding the fundamental forces reshaping the global economy and positioning yourself accordingly. The people who understand this shift and act on it will likely see their wealth multiply dramatically over the coming years. Those who stick with conventional wisdom and traditional safe assets may find their purchasing power steadily eroded by monetary debasement. The choice is yours, but the window of opportunity won't stay open forever. The longer you wait, the more expensive these alternative assets become, and the less purchasing power your current savings will have. Remember, we're not just talking about making money in the markets. We're talking about preserving and growing your wealth during a fundamental transformation of the monetary system. This is a once-in-a-lifetime opportunity to position yourself on the right side of history. The financial reset is coming, whether we're ready for it or not. The question is whether you'll be a victim of the transition or one of the beneficiaries. The difference comes down to understanding what's really happening and taking action while you still can. The signs are all around us. The divergence between financial markets and economic reality, the flight of capital into alternative assets, the breakdown of traditional monetary relationships. The question is not whether this will continue, it's how quickly it will accelerate and how dramatically it will reshape the financial landscape. For those who see it coming and position themselves correctly, this could be the greatest wealth-building opportunity of their lifetimes. For those who remain trapped in the old paradigm, waiting for a traditional crash that isn't coming, it could be financially devastating. The choice is yours, but time is running out. The once-in-a-lifetime financial reset is already underway. The only question left is which side of it you'll be on. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.